We start with the troubled global banking sector. European markets have closed down more than 3%, spooked by a major sell-off of shares in the Swiss banking giant Credit Suisse.
It wasn't the corporate espionage scandal, the alleged laundering of drug money, or the private banking fraud that brought down Credit Suisse. In the end, it was a 5-word interview response from its biggest investor.
For 167 years, that logo represented the gold standard of global wealth: privacy, stability, Swiss neutrality. But, in March 2023, that standard didn't just fall, it completely evaporated. Over one single weekend, Credit Suisse was just erased from existence. So was it a market panic? A conspiracy? No. When we cracked open the files, we found something so much worse. Today on Corporate Forensics, we are opening the Weiss report and the FINMA files to understand how a bank with $500 billion in assets literally committed suicide by 1,000 cuts.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not.
From Credit Suisse to crisis.
So this right here, this is the crime scene. It's a 16-year-long bleed-out that ends in, total system failure. Think about this. Back in 2007, one share of Credit Suisse would have cost you over $76. Fast forward to March 2023, it's worth less than $1. This wasn't some sudden heart attack, right? This was a chronic wasting disease. And to really get what delivered that final fatal blow, we gotta look at the pre-existing conditions. What made the bank so sick in the first place? So, Act 1, a crown of cracks. You see, for most of its history, Credit Suisse wasn't just another bank. It practically was Switzerland. It was so tied into the nation's identity, its failure felt unthinkable. But as we're about to see, even the most solid foundations can rot from the inside out. And its origin story is honestly pretty epic. It's all about national ambition. You've got this guy, Alfred Escher, a huge deal in Switzerland, who starts the bank for one big reason: to fund the country's future. We're talking about the railways. He wanted to make sure that Swiss infrastructure was built with Swiss money, keeping foreign banks out of it. It was basically a declaration of economic independence. And wow, did it succeed. Beyond anyone's wildest dreams. Credit Suisse didn't just stop at the railways. It went on to fund the national electrical grid, it bankrolled entrepreneurs, it became the biggest, most trusted bank in a country that's literally famous for its banks. For decades, if you said Credit Suisse, you were basically saying rock-solid security. But, and this is a big but, behind that shiny, formidable facade, a really dangerous, kind of reckless culture was starting to fester. Yeah, and you don't have to take my word for it. The Swiss financial regulator FINMA did not pull any punches in its report after the collapse. They pointed to a long and frankly ugly history of misconduct. We're talking about everything from helping rich Americans dodge taxes to laundering money for drug traffickers. Seriously, each one of these scandals was another crack in the foundation, chipping away at the one thing a bank absolutely cannot survive without: trust. And if you want a perfect example of just how deep that route went, look no further than the totally bizarre Spygate scandal in 2019. Get this, when a top exec left to go to their rival, UBS, the bank's own COO hired PIs to spy on him. Can you believe that? It was this shocking, paranoid move that blew up in the news everywhere. But here's the thing, as weird as that was, it was really just a symptom of a much bigger cancer growing inside its investment bank. That was a division where risk wasn't something you managed anymore. Nope, it was just an obstacle, an annoyance getting in the way of profits. Okay, Act 2, the $5.5 billion cut. So, fast forward to March 2021. This is 2 years before the whole thing comes crashing down. A deal with just one single client is about to deliver a catastrophic, completely self-inflicted wound. And this is the moment that exposed the bank's fatal flaw for everyone to see. $5.5 billion. Let that sink in. That is the size of the hole that was blown in Credit Suisse's balance sheet by the collapse of just one client, a family office called Archegos Capital. And what's crazy is that was way more than any other bank lost in this whole mess, way more. And as all the forensic reports later proved, this wasn't just bad luck. Oh no, this was a complete, systemic, and 100% avoidable failure. Okay, so to really get what went wrong, we need to talk about the weapon that was used. It's something called a total return swap. See, Archegos wasn't actually buying stocks. Instead, it was using these complex deals to make gigantic bets. So it worked like this. Credit Suisse would buy the stock, but Archegos would get all the profit or all the loss. The bank is supposed to protect itself with a cash cushion, right? They demand collateral or margin, just in case those bets go south. That's the safety net. But here's the kicker. Credit Suisse wasn't demanding nearly enough collateral. In fact, they basically let the risk run completely out of control. Just look at this. The bank's total exposure to this one client, Archegos, swelled to an insane $24 billion. That's 4 times bigger than their next largest client. We're not talking about just bending the internal risk rules here. We're talking about shattering them into a million pieces. And here's where it gets really mind-boggling. That FINMA report confirms this wasn't some accident or oversight. It was a choice. Instead of slamming on the brakes when the risk was screaming out of control, the bank's own employees were the ones disabling the safety systems. It's like they saw all the warning lights flashing bright red on the dashboard and they just taped over them. They just kept raising the limits over and over, all because they wanted to keep this one big spending client happy. So the final verdict from the Archegos autopsy was just damning. What it showed was a fatal disease inside the bank, a culture that rewarded making money no matter the cost. Risk warnings ignored. They let this one client build up a massive, concentrated position in just a handful of stocks. And get this, the top executives, the people who were supposed to be steering the ship, they were never even told about the giant ticking time bomb in their own portfolio. It was all about short-term profits, completely forgetting about, long-term survival. And that brings us to Act 3, the death blow. Losing $5.5 billion was a massive wound, for sure. But the real damage, the thing that would never heal, was the hit to its reputation. After Archegos, everybody knew Credit Suisse was broken. It wasn't a question of if it would fail anymore, it was just a question of when. By March 2023, the bank was a tinderbox of distrust, just waiting for a match.
You really couldn't have picked a worse time for this. Out in the US, Silicon Valley Bank had just imploded, and it sent these shockwaves of panic all through the global financial system. Everyone's nerves were shot. And in that kind of high-anxiety environment, every single eye turned to the one bank everyone knew was the weakest link in the chain, Credit Suisse. They were already bleeding cash. Clients had yanked over $100 billion just in the last few months of 2022.
And then there it was, the spark. The chairman of the Saudi National Bank, and you have to understand this was Credit Suisse's biggest, most important shareholder, he's doing a live TV interview. He gets asked a really simple question. Hey, would you put more money in? His answer? 2 words. Absolutely not. Now, to be fair, he went on to explain why, something about regulations keeping them from owning more than 10%. But it didn't matter. In that moment of pure market panic, all anyone heard was the biggest investor screaming, "No more money." The reaction was instant, and it was brutal. The stock price just fell off a cliff, dropping almost 25% in a single day. That slow, painful bleed of clients pulling their money out, it suddenly turned into a catastrophic, unstoppable hemorrhage. The digital bank run had begun. Just think about this. In the first few weeks of that quarter alone, another $69 billion vanished from the bank. This was a full-on 21st century bank run, happening at the speed of light, at the click of a button. It got so bad, so fast, that the Swiss government had no choice but to step in. They had one frantic weekend to stop a meltdown that could have taken the whole global financial system down with it. And the solution was basically a forced marriage. The government made their longtime rival, UBS, buy Credit Suisse for just over $3 billion. That is a tiny, tiny fraction of what it was once worth. And just like that, a 167-year-old institution, a pillar of Swiss pride, was gone, erased from existence. So what's the final takeaway here? Well, that quote says the bank failed in a crisis of confidence. And that's exactly right. The scandals, the losses, those were the cuts. But the thing that actually killed Credit Suisse was the loss of the one currency no central bank can print: trust. You see, in banking, risk management isn't just a department, it's the brakes on the car. Credit Suisse didn't crash because they didn't have brakes, they crashed because the executives in the driver's seat refused to use them. The Weiss report calls it a lack of accountability. The market called it the end. If this autopsy revealed something new to you, hit that like button and subscribe. We have more files to open. My question to you is, can UBS survive absorbing this much toxic risk? Let me know your thoughts in the comments.